I want to start by doing a couple of very brief introductions, and then we're going to have a conversation up here. Joel Manfredo and I will be asking Fred some questions. We'll leave some time at the end for some audience questions. But we're very appreciative of you all being here. So let me first introduce my partner in crime on stage, which is Joel Manfredo. Joel is 25 years or more experience in CIO, CTO positions, often in the real estate business. So he worked for the Rouse Company, which is a development company on the East Coast, and then he was the CIO for the Irvine Company here, and most recently for the County of Orange, the CTO. And he's been a great friend of my school in helping us pull together this corporate partners program and agreed to sit with me today. The guest of honor today is Fred Wilson. Fred is a friend of mine that I have not seen in 30 years. We went to school together at MIT. And it's real fortunate that he was agreeable to coming out to visit us. Most of you know Fred is an extremely successful venture capitalist and blogger headquartered in New York. On the venture capital front, currently he's a co-founder and currently working in Union Square Ventures, which has invested in firms, has investments in firms, Twitter, Tumblr, Zynga, lots of big names, fantastic stuff. I don't know how many of you will have seen his blog, AVC, a venture capitalist, and it's really great stuff. There's a handful of blogs. I'm not a big blog person, but there are a handful of blogs, and I don't read them every day because if I did, I'd never get any work done. I go periodically, and then you kind of can't leave because you want to keep reading more and more. And Fred's on venture capital is just fantastic. So Fred got his undergraduate degree at MIT and a master's degree at the Wharton School before heading into venture capital, and I described some of that. So Fred, welcome. Joel, welcome.
Thank you.
So as I mentioned, I've known Fred for 30 years. We were fraternity brothers at MIT. And the natural question for me to start with is, how do you get from a mechanical engineer at MIT to being a wildly successful venture capitalist? What's the short version of your life story?
Well, I wasn't wildly successful for most of my career. Overnight success that took about 35 years in the making, I guess.
Is your mic on?
No, my mic is on. Can people hear me? Okay. Maybe I just need to move this up a little bit. So I decided pretty early on in my career that I wanted to do venture capital. So I figured that out as I was coming out of MIT and thinking about what I wanted to do with my career. It took me a while to figure out how to get into the venture capital business, but I was able to do that by my mid-20s. And then I spent the first 10 years, from say 25 to 35, in really an apprenticeship model, working for a couple of venture capitalists who at the time were in their late 50s, and learned a lot about the business from them. And then in my mid-30s, I started a firm called Flatiron Partners, and that was a boom and bust type of situation. We did some amazing things, and we did some pretty boneheaded things. And it was also at the time of, the internet had just hit, and it was a little bit of a gold rush mentality, and we were very much in that mode. But I learned tremendous amount from that experience. And then in 2003 and 2004, I started Union Square Ventures. And really, it's been the past 10 years, along with my partner Brad, who I started Union Square Ventures with, that I feel like I've actually gotten pretty good at the business. So it's taken a long time, and it's definitely a kind of business where you have to learn by making mistakes. I think that's probably true of any business, but certainly in the venture capital business, it's very, very hard to be good at it until you've done it for a while and learned some of the difficult lessons that you have to learn.
Is apprenticeship still somehow the best way in? Or?
I think it's the best way in. It's what I encourage people to do, but I also think it's very useful to do something that I didn't do, which is to work in startups. And if I could do anything differently, that's the one thing that I would have done, because I think it's when you work with an entrepreneur, having empathy for what their life is like, and being able to talk to them in a way that you've been through it, you've been through the exact same experience that they're going through is very, very helpful. And I think part of the reason that it took me so long to get good at the business is I didn't have that. And I have friends who are in the venture capital business who did do that. And I think that they got up the learning curve more quickly as a result of having worked in startups. So I would definitely, if you want to do what I do, I would encourage you to go work in some startups.
Thanks.
So you've known him for 30 years. I've known Fred for 30 minutes.
That may be an advantage.
And Hal, I noticed I got all the kind of negative questions.
He's a friend. I can't ask
He wants to be friends for another 30 years.
So I was reading the PitchBook first quarter 2013 report on private equity and venture capital fund performance a couple of weeks ago. The following excerpt caught my attention. It said, for the high-risk, high-reward paradigm of VC investing, the fund returns over the last decade have been decidedly disappointing. VC funds trail all types of PE funds by a wide margin in every horizon internal rate of return time frame except for the most recent one-year period. Also, a March 8th Wall Street Journal article stated that hedge funds are encroaching on the venture capital space and that the VC industry expects investment exits to drag. Please give us your views on the general health of the venture capital business.
Well, so venture capital is tough place to make money. And there's a couple statistics that I think are important to understand about the venture capital business. The first is that on a given portfolio of, let's say, 10 investments, only 3 you'll actually get a good return on. The other 7 you're actually going to either barely get your money back or, worst case, lose your money. So I like to compare it a lot to baseball. And the line I like to use is, if you're a venture capitalist and you can hit 333, you can go to the Hall of Fame. and so it's a business where you lose more than you win. So that's one thing that's very important to understand. And the other thing that I think is true about the venture capital business is that the returns tend to be tightly held among the top performing firms, and that the numbers I've heard, and I don't actually, have never seen the raw data, are that between 10 and 20% of the firms produce all of the returns in the venture business. So that means that 80 to 90% of the venture capital firms operating lose money. And so when you look at average, it's a terrible asset class to be in. But if you can be in the very best firms and through them get into the very best companies, then you can make very good returns. We have been fortunate at Union Square Ventures to have 2 venture capital funds, one which we raised in 2004, one which we raised in 2008, that look on returns that we've given back to our investors to be top performing funds. And I'm very proud of that because it's hard to do. But I also realize that I may not do it again. That's how hard it is to do. So, it's a difficult business to be in, and you're always trying to find that next big thing, and sometimes pretty hard to find. So I would definitely not recommend people go put a bunch of money into venture capital. It's a tough way to make money.
And the encroachment of the hedge funds on the VC community?
Well, so so I'm not entirely sure what you mean by that. Are they taking capital away from us? Meaning, are they going to the same people we go to for money and taking it from us? Probably yes, because they can perform more consistently than we can. They also sometimes come into the companies that we invest in and put money into those companies. And so they compete with us in 2 ways.
I think the latter was what the point of the article I was reading was.
Yeah, I think it's true in both cases.
Okay. Hal?
Thanks. So I'm the dean of the School of Computer Science and Information Science, and therefore a member of two different dean's groups. But I was at a meeting recently with both sets of groups, and there were only a few topics they all agreed were critical, and one was entrepreneurship.
Right.
It was a very interesting discussion there, though, about the relative importance of the business plan and the idea.
Right.
And I'm curious if you want to say a few words about that.
I think we make too much of business plans in the world of startups, and I don't put a lot of stock in a 20 or 30-page business plan because I think the planning process is a good thing. But there's a great Mike Tyson quote where he says, "Everybody has a plan until they get punched in the face." And so, you know, the problem with the plan is there's just no way that the plan is actually going to play out the way it was written. So I think what's much more important is demonstrating that you can actually build the thing. So I think prototyping is more important than planning. And this is the thing that I really would push students, entrepreneurs, schools, any kind of exercise in trying to get something off the ground. As opposed to running a business plan competition, I would be in favor of running a prototyping competition. And you know, I'm a big fan of hackathons where students get together for a weekend and try to code for 36 hours straight and then get up on stage and kind of show the things that they built, because that's a great way to showcase the idea, even though, you know, it's a prototype and it's barely held together with you know, glue and Band-Aids or whatever. It does begin to show that the person who had the idea has some capability of executing against it. So I think that's where I would push students.
I'm pleased to hear it. We have a product development competition which is on right now.
Right.
And we also have a couple of our students have been very entrepreneurial in this vein and have app jams regularly, competitions, game competitions, things like that. So
I think that's the way to go.
Thanks.
So tell us how you evaluate a potential investment. Now, I got the part about prototyping and the ability to execute. Beyond that, what kind of steps do you go through? What do you look at? How much do you evaluate the management, those sorts of things?
Well, so we often invest in a company when there is somewhere between 1, 2 to 5 to 10 employees. And so there isn't much of a management team at that point in time. And so we tend not to focus too much on that, because our view is that we can help the founders build a management team. That's something that we actually can do pretty well, because we've been in the business a long time and know a lot of people, so we can help bring the right people to the opportunity. There's a couple things we really want to focus on. We want to know why the team is doing this. And a lot of people kind of, when I tell them this, they look at me with a little bit of a quizzical look on their face, because they don't really understand why that matters too much. But I think it matters terribly why somebody is doing it. And there can be a number of different reasons why someone's starting a company that are all valid. But it's important that, to us, that it comes from, the startup idea comes from something other than simply wanting to make money. Now, we wouldn't want to invest in somebody who didn't want to make money. Right. But there should be something more than I want to make money. And a great example would be, you know, I worked in this company, and you know, we could never find somebody who could supply us with a piece of technology to solve this problem. So, damn it, I quit my company and I went and built that because we needed it, and I knew that we needed it, everybody needed it. That's a great reason. Or somebody said, you know, I started this company, and you know, we built a product, but we didn't build it as well as we could have, and we sold the company, and you know, I really want to do it. I know I can do it better this time. Like, those are the kinds of reasons that I look for. Why are they doing it? And then also, is there something that they bring to the idea that's unique and different? It could be that they've done it before, or it could be that they really understand the market very well or something. So a lot of it is sort of the intangibles around the team and the idea and why they came to, and how the team came together, and are they complementary to each other. I really like the nuggets that I like to see in a company are a founder who's very product-centric, who's thinking about the product more than how to build it, along with somebody who's more of the builder. So it's maybe the architect and the contractor. And those complementary skill sets are very important to me. So those are the kinds of things we look for, is the composition of the team, why are they doing it, are they complementary, do they bring some unique expertise to the equation.
What about the breadth of the market for that product?
Yes, that's critical. We would want to see a very large market. A large market can solve a lot of problems.
Let me write that down.
So as I mentioned in the introduction, your name and your partnerships associated with a lot of very successful ventures. I'm curious, is there a most successful venture that you could describe, and why you would say that? One of your favorites?
Well, I think, in many ways, for me, Twitter is probably the investment that I think about as the most interesting and in some ways most successful investment I've made. And that one was, the thing that I'm most proud about that investment was that we had conviction around that company and that opportunity before anybody else in the venture capital business had conviction about that. And we're based in New York. That company was based and got formed in San Francisco, and they're 8 out of the top 10 firms in the venture capital business are probably in the Bay Area, and none of them saw that opportunity at the time we saw it. They may have seen it, but they didn't understand it. And so I'm very proud of the fact that we had a vision for what Twitter could be, and had the conviction to make that investment at a time when our competitors didn't. And I'm also very proud of the work that I did early on with the company in terms of helping them make a couple of acquisitions that ended up being really important for them, hiring a few people that ended up being really important for them, and a few other things. That would be one that I would point to. It may or may not be the most successful investment that we've made in terms of total dollars in, dollars out, but it's certainly going to be in the top 2 or 3.
That's fantastic. You're really, truly visionary. I'm not sure how you see that. Related question.
Well, I can tell you why I saw it.
Yeah.
So back in 2003, as I was getting ready to start Union Square Ventures, I decided to start writing the blog that you mentioned. And I found very quickly that by publicly being able to print my ideas, print meaning just publish them onto the internet, I was getting a lot of benefit back. I was getting feedback about my ideas. The blog was sort of flypaper for entrepreneurs, so I'd say something like, I'm interested in machine learning, and then a bunch of entrepreneurs who are working in machine learning would contact me, and so it was a good way for me to sort of proactively filter the deal flow so that we were seeing the things that were truly interesting to us. And I started advocating to everybody I knew that this blogging thing was tremendous and that everybody should do it. And very few people found that they could do it. It was too time-consuming. Being able to actually sit down and compose 5 or 6 paragraphs of coherent thought on a regular basis was not easy for people. And so very few people ended up doing that. And when Twitter came along, I immediately saw it as a lightweight form of blogging. It was as simple as sending a text message that would allow, at least an order of magnitude, maybe 2 orders of magnitude more people to do essentially the same thing and get essentially the same benefit. And so that's what I saw. And I think had you not been doing what I was doing with my blog, it may have been very difficult to see that.
That's great.
Speaking of your blog, I recently read the one entitled "When Things Don't Work Out."
Right.
which likened early-stage venture capital to baseball, as
Right.
you mentioned, and identified two general scenarios: slog it out or hit the wall.
Right.
Which of your, you know what the title of this thing is, right?
Right.
Confessions. Which of your investments was the least successful, and what went wrong?
Well, back in the Flatiron days, we had a few investments where we invested between $15 and $25 million, which is a lot of money, in companies that we ended up getting complete wipeouts on. Companies like Cosmo.com, Urban Box Office, and several others. And in every one of those cases, we did 2 or 3 things wrong at the exact same time. We put too much money into the companies too early, before they had validated their, the word that people like to use now is product market fit, and I like that word. Before they validated that they had the right product for the right market and that there was a customer for it. And we thought we could buy our way into the market with capital. And in all of those cases, we ended up coming up empty and lost, a fair bit of money. Now, the good news is that we had made a fair bit of money before we lost a fair bit of money. So it was sort of like you had gone to the casino and you'd made $1,000 and we ended up giving back 500, right? So the Flatiron experience ended up being a profitable one, but we gave a lot of money back that we probably shouldn't have by doing some of these, what I would say, overfunding too early. And that's something that I've learned to not do, and we don't do anymore.
Thank you.
So now you've been doing this for 25 years in some form or other.
Right.
Do you get surprised still? Are there surprises? Could be positive or negative surprises. Can you give us an example?
Yeah, I get surprised all the time. Yeah, because I still hit 333, at best, right? So there's still, you would think you'd get smarter. And I do think I'm smarter, and I do think we're smarter as a firm than we were, 10 or 15 years ago. But I get surprised by all sorts of things. I've backed entrepreneurs who've been successful 2 or 3 times, and then they completely whiff on their next one. And you think, how can that happen? I'm surprised when, one of our companies, is competing in a market with, a bunch of companies who have much more capital and much more resource than we do, and we still beat them. So there's all kinds of things that are not logical or rational, at least on the surface, that happen. We have a company that, I think we're going to end up writing off that, 2 years ago I thought was going to be a huge success. And now the market has changed. They didn't adapt quickly enough, and they're not making money anymore, and it's going to be tough to turn it around. So yeah, I'm constantly getting surprised.
We were talking earlier on, my background's in statistics, and so is there's just a random element to this that you must abide by, or not?
I don't think it's
not so.
I don't think it's random. I just think that technology is a fast-paced, ever-changing business, and things can change a lot more quickly than you might imagine. How you carry a BlackBerry, I noticed that, and
don't tell anyone.
But 5 years ago, you'd probably look at RIM, the company that makes BlackBerry, and say, boy, this is one of the great technology companies of our time. And today, they're on the ropes. And it could be that Apple will be on the ropes in 5 years. I'm not predicting anything. I'm just saying that
they were, right? I mean,
that could happen in the technology business, where I guess it could happen in any business, but I think the technology business is more prone to these kinds of changes than most.
Thanks. Joel.
Okay. So here's a quote. Yeah, boy, we really screwed a bunch of things up.
Right.
That was Flatiron Partners.
Correct.
That was you.
Yes.
Please elaborate.
Well, I did sort of talk about some of that in the last question, but you know, so the thing about Flatiron Partners was we started it in 1996, and we had a very simple investment thesis. We're going to invest in the internet, which turned out to be a good investment thesis in '96. But we didn't know anything about the internet, and nor did anybody else, frankly. So we were kind of making it up as we went along, and I think that for a while, anything you invested in that was related to the internet was succeeding. Maybe not just because of its business success, but because everybody wanted a piece of the internet, and so these stocks just kept going up and up and up. But there came a time when you know, the business fundamentals started to matter, and it was a case of a lot of these companies were the emperor that had no clothes, and they were discovered as such, and they ended up going all the way to zero, and you know, we went along for that ride in many of them, and so, you know, I just feel like when I said that quote, and I said that quote in like 2005 or something in an interview, I felt I was just being honest about you know, how we performed at that time. And I think a lot of people in the venture business did the exact same thing we did, and a lot of people in the venture business probably haven't been as honest as I was about that, because the entire venture industry screwed up. It wasn't just us. But what was good was that after all of these companies sort of crashed and burned, it caused both the entrepreneurs and the investors to do some deep soul searching. And we certainly did that, and I think that's what has made Union Square Ventures so good, is that we thought long and hard about what worked and what didn't. And one of the big takeaways that I came away with was that the internet is a two-way system. And a lot of the things that we invested in back in the late 90s were essentially taking things that worked offline and porting them to the internet. So, oh, let's port a newspaper to the internet, or let's take classified advertising and put it on the internet, or classified advertising actually is a bad example of what I want to talk about, because it actually is a case in point. But one of the things I learned was that if you want to build businesses on the internet, you need to take advantage of the fact that it's a two-way system. Classified advertising turned out to be better on the internet than off the internet. Craigslist being the classic example of that. You could do classified advertising in a much more efficient manner on the internet because it was a two-way system. You didn't need people answering the phone. People could just write their own classified ads and post them. So we took that lesson, and when we started Union Square Ventures, we said we want to invest in these networks. And a network is sort of the archetypical two-way system. And that has served us very, very well. And we don't invest in things that really look just like businesses that exist offline and have just been put on the internet. And that's a big lesson that I learned. And having invested in a bunch of things that really weren't any better businesses on the internet than they were off the internet, we figured out how to invest in businesses that are better on the internet.
Okay. So as we've talked today, you have still have an interest in higher education for parochial reasons. You have children
right.
entering higher education, but also professionally. You mentioned being on the Board of Visitors for Computer Science at Princeton. We have a similar group constituted here. Can you talk a little bit about how you think the academic world is doing in preparing students when it comes to innovation and entrepreneurship?
Pretty well, honestly. I think that as I travel around to lots of higher education institutions over the past 4 or 5 years, I feel that most every single one of them is trying to make these opportunities available to students, and a lot of the students are taking advantage of them. And I don't think there's maybe a better time to try to be an entrepreneur than when you're in college or grad school. You have access to lots of other bright people. You probably don't yet have a family and a mortgage and all those kinds of things, so that you can take a fair bit of financial risk. And you're potentially touching a lot of cutting-edge technologies in your studies or in your research. And so I think that a lot of schools have made a big deal about this, and I see a lot of institutions starting to create facilities where students from the various schools can come together and co-collaborate on projects. So I feel pretty good about the way higher ed is embracing entrepreneurship.
Are there things you'd like to see more of? Advice you give when you go around?
I think that getting the students good mentors is something that's really important. And it's not just having a bunch of people like us to come in and judge a competition, but it's people like us who are willing to engage with them on a regular basis and give them feedback and advice and counsel. And I think that's something that, you have we were talking before, and you have a CEO roundtable. So there's obviously, here at UC Irvine, there's a connection between the business community and the university, and getting those people in the business community to be willing to take the time to mentor these teams of students and give them some wisdom that they've learned over the years in business, I think is something that I would like to see schools do more of. And I've seen some innovative ideas lately. I know of a master's program that is giving every graduate of the master's program a 6-month stipend when they graduate to work on a startup. So they graduate not only with a diploma, but they graduate with maybe a $3,000 a month stipend, so that they have, because this particular program, and I'm not naming names because I don't think they've necessarily announced this program yet, so it may not be public. They want their master students focused on their research and their thesis and getting their diploma, and so they don't want them actually doing, working full-time on their startup while they're getting their master's degree, so they give them this 6-month stipend. And that's a pretty cool idea because it's a way to take their research and actually start to focus on commercializing it. So there's a lot of interesting ideas out there that I'm seeing that I like.
Thanks.
I'm intrigued by the intersection of pervasive computing and machine learning
Right.
that you blogged about. Could you share with us your current thinking as to how that combination may give rise to VC opportunities?
Yeah, so pervasive computing is a term we used maybe a decade ago, and it kind of fell out of favor, but I like it to talk about what I think are the next generation of devices that consumers are going to use to do computing-related functions. And I'm thinking of watches and glasses and smarter cars and smarter homes and these things are all going to have operating systems in them. They're all going to have user interfaces in them. We may be using voice to interface with them. We may be using gestures to interface with them. And what's interesting to me about that is that I think those devices are going to be connected to services in the cloud, like the services that we're already using on our mobile phones and our tablets and our desktop computers, things like Gmail and Dropbox and other things like that. And so, and these are personalized. We'll all have personalized accounts that these devices will be connecting to, and so we'll be storing a lot of data in the cloud about the things that we encounter and the things that we do with these devices. And I think that using machine learning to start to understand our use of these devices and give us back services that are personalized and tailored to the usages of these devices is a very big opportunity, and it's going to require a lot of data science, because the amount of data exhaust that we're going to be producing is just mind-boggling. I mean, if you just think about driverless cars, and I don't know how soon we're going to have driverless cars. I've been told by some people in the auto industry that that the auto industry could give us driverless cars soon, but they don't think that we want them. And so they're not pushing it as hard as they could, because they think we still want to drive our cars. But in any case, if you think about driverless cars, I mean, that's a massive exercise in machine learning. Right? Hopefully the machines are smart enough that they don't crash into each other. So I think it's a big opportunity for the next decade and a half.
Do you worry about security and privacy?
Yeah, I do. I worry a lot about security and privacy, and I think that will be also a very big investment opportunity, and for entrepreneurs, a great startup opportunity is to create services that give us control of the data that we're creating. I mean, I personally think that, and I have an Android phone, and one of the features that Google has in Android is that every picture that you take gets uploaded to Google+. But I also put Dropbox on my phone and enable their feature called Camera Upload, so that now there's 2 services out there that have every photo that I take on my phone. And I think more and more we're going to be doing that kind of thing, where we're not just going to be trusting all of our data to just one provider, because if that one provider does something bad, we want to fire that provider, right? But if they have the only unique copy of all of our data, then we can't fire them, right? So services that basically allow us to second source, or maybe even triple source that kind of thing, so that we have more control over these providers, so that they don't have all the control over us. These are things that I think are going to become increasingly important, and services that entrepreneurs are going to need to build.
What about privacy? I mean, I heard somebody say that people are very concerned with their privacy until there's a Lexus and you can sign away, check off that, then they don't care about their privacy anymore. What do you think about all this learning and data that gets captured? How much is available to people, and how much they know to you and know about you, and where is the legal community with respect to this?
Well, I think we're going to see more and more regulation around this, because I think that the internet is such a powerful tool for companies to collect data on us, that we're going to need more rules and regulations. And I think that's good and bad for entrepreneurs. Because anytime that there's regulation, it makes operating a company more difficult. But I also think that it will create some opportunities for entrepreneurs to provide services to help people comply with these rules and regulations as well. So I think we'll see more privacy regulation. The funny thing about privacy is that I'm not sure that we as humans can quite understand where we need to be drawing the lines. And I think there's some places where we have a desire for privacy, where probably less privacy would be good for us. And there are other places where we're very promiscuous, where we ought to be more private. And an example of an area where we have a tendency to be very private, where I think less privacy might actually help us, is in healthcare data. So we all have this idea that we don't want our healthcare data publicly available, because then maybe we could be taken advantage of, or maybe somebody wouldn't hire us, or someone wouldn't give us an insurance policy. But I think there's a lot of value that could come from creating co-ops of healthcare information and looking at like-minded genomes and like-minded behavior types and seeing the patterns that come out of that and being predictive about the way we need to behave in order to manage the healthcare risk given all of this data. So I actually think in some ways if we could become more open with healthcare data, we could potentially become healthier as a society. And yet, I think our nature as human beings is to be very private about that kind of stuff. So it's a double-edged sword, I think, privacy, and in a very complicated area in general.
I have millennial children.
Mm-hmm.
They have a completely different view of privacy than I do. Could you relate it to the generational differences?
Well, I personally think that people who've grown up with the internet as part of their lives from as far back as they can possibly remember are actually much more sophisticated about this stuff than you might think. They know what information should be public, and they know what information should be private, and they have tools that they use every single day to manage how that information is shared. And I actually think that it's the older generation, my generation, and older, who maybe are the least sophisticated about this because they didn't grow up with this technology. I mean, when you're a 14-year-old kid and somebody does something to you on the internet and you're embarrassed, like that's like a big deal, and you learn from that at an early age, and you get sophisticated about how to behave, and you learn tools that you can use to manage that, and you think carefully about where am I going to put this information, where am I going to store it. The one area that I don't know how good the millennials are is in passwords. Mm-hmm. And I actually think probably everybody is pretty bad at this. I have a partner who I was telling Hal is a computer science undergrad from Harvard and a computer science PhD from MIT, and he has very sophisticated algorithm for creating passwords to all of the services he uses, and he's very, very diligent about that. I'm somewhere in the middle. I'm pretty careful about passwords on the sites that I think need to be protected, but I have a pretty good sense of the passwords my kids use, and they're pretty hackable. So that might be an area
As
where...
a parent, that's a good thing, right?
Well, I don't know about that. So if I can get in, anybody can.
I want to leave some time for the audience, but maybe I'll ask you one last thing. A couple of nuggets that you would leave the audience about VC and technology?
Well, one of the things that I have observed in my career is that many of the most successful companies that I've been involved with have been projects that a lot of people laughed at and made fun of. And I think that doing something that is borderline crazy or seen as a toy or, that's silly, why are you messing around with that, is often the place you want to be. And doing something that everybody is doing, and there's a sort of contrarian element to that, but there's also, I'm a big fan of Clayton Christensen, and he's written a bunch of great books, but the real seminal book for me was The Innovator's Dilemma, which was the first book he wrote. And he talks about how, there were these, I forget what they're called, these steel mills, which, were, they made really, really inexpensive steel, but they were they couldn't really make a lot of steel, and the steel industry kind of laughed at them and said, that'll never be a big thing. And then the next thing you know, that form of making steel kind of took over, and the big steel mills kind of got hurt very badly. So
continuous casters.
Yeah, and so I like to look at, in the technology industry, I like to look for things that people are kind of saying, that could never be big, that'll never work, and things that everybody's kind of agrees are going to be the next big thing. It's kind of hard to make money there because there's so many people working on it. So that'd be one thing I would encourage people to think out of the box and work in areas that many people don't think are fruitful areas or think are trivial. And then the other thing that I think is important about VC is that the relationship between the entrepreneur and the investor is a really important relationship, and I think a lot of entrepreneurs don't think enough about it when they enter into the relationship because they need money to move their project along, and I understand that, and I understand how important it is to them to get that capital so that they can pursue their vision and their business plan, but I would just caution everybody to make sure that you're in business with an investor who you're truly aligned with and that they really that they're investing in your company for the right reasons. It comes back to this thing about why. Why are you starting this company? And it can't just be about the money. There has to be some other reason why you're doing it. And I think you want to ask that same question to the investors. It's a hard thing for you to say, why are you investing in my company? It sounds like, it doesn't sound right. But I think it's important to try to, as you're having your conversations with your investors, is to get to that question, and make sure that the people who are investing in your company are investing in your company because they believe in you, they believe in your vision, they enjoy spending time with you, they want to work with you. That's the basis for a relationship, and all business is relationships at the end of the day. So I would just encourage people to be careful about that matchmaking process and thoughtful about it.
Thanks a lot, Fred. I really appreciate it. So we do have time for a couple of questions from the floor. We'll go 1, 2, and then 3 in the back. Go ahead.
Hi. If I have a product and an extraordinary startup, hypothetically,
I'm sure you do.
how do I get on your radar screen?
Well, what I encourage people to do is make sure that I am going to be interested in what you're working on. And I think one of the big changes in the venture business over the past 10 years is that venture firms are now very open about the companies they've invested in, the areas they're investing in. And so if you're doing e-commerce, then focus on investors who have a track record of doing e-commerce. If you're doing something in hardware, focus on investors who have a track record and an interest in hardware. So do your homework on who the best investors would be for your project. And then once you've done that, then I think it's important to figure out how to network your way in. And so you can try just sending somebody a cold email. That's generally not going to be very helpful. So again, kind of do your research on the person, figure out the companies they've worked with. LinkedIn is a great product for this kind of thing. How can I find somebody who knows this person who can make an introduction and come through that route, and then you're going to have a much better chance of getting that meeting. But it's a lot of work to do to get a meeting with somebody if they're not even going to be interested in what you're doing. So I would start with the filter of who are the 10 or 20 investors who have a track record of investing in a company like mine, and then go do the work to figure out how to connect into them.
Thank you.
Second, yeah.
I was curious to find out what you think about crowdfunding sites such as Kickstarter and whether you think there's a future for those.
So just in the spirit of full disclosure, we're probably the largest investor in crowdfunding that there is in the venture business. We're investors in the Lending Club. We're investors in Kickstarter. We're investors in Funding Circle. We've just signed a term sheet to invest in another crowdfunding company. We have a crowdfunding company in Europe that we haven't yet announced that we've been investors in for a few months. So we have made a number of investments in this category. We are big believers in it. The internet is great at a lot of things, and one of the things it's great at is matchmaking at scale. And the thing about crowdfunding is that you're raising $2 million from 2,000 people as opposed to $2 million from one person. And so it's all about matchmaking at scale. And what's great about crowdfunding is that, you know, in a risky investment category, you're able to get the capital you need, which is, for the sake of argument, $2 million, but nobody's taking more than $100 or $200 of risk individually. So I think it's actually, from a risk perspective, actually very good in many ways as well. So we're very big fans of crowdfunding.
Yeah.
From the standpoint of just products in general, I mean, the internet and technology has the ability to kind of circumvent the traditional distribution system, which obviously is very attractive. Is there a reason why we don't see as many things like, let's say, a tire that could last for 100,000 miles because it gets regenerated, or a water that you buy, let's say for some reason it regenerates water and whatnot? Those multiples in those situations aren't anywhere near as attractive as technology. So my question is that one of the reasons why those things just don't come up on the radar screen as much as technology?
Well, I think part of the problem with those kinds of businesses, I think we need to come up with a way to finance those kinds of businesses because society needs those kinds of innovations. The problem with the capital markets are that capital markets in a truly capitalist system like we have here in the United States, money flows to where you get the highest returns. And the problem with those kinds of businesses is that they often take more capital to get the proof of concept, and then you're going into an industry that may be fairly concentrated. You mentioned tires that last for well, I don't know, for a long time, and there may be 4 or 5 tire companies that control the market, and so it's a tough market to enter or whatever. So it gets back to the question of crowdfunding in some ways. I think if there were ways that entrepreneurs could get access to capital that was unlike me, compensated to generate the highest return for our investor, that we might see more activity there. There's a crowdfunding there's been 3 or 4 crowdfunding platforms that have been focused on funding hard science. And none of them have been successful yet, but I'm quite taken by that idea because we have the federal government cutting back on the amount of research funding that it's backing, and there's less and less funding for really true research and hard science problems. And so if there was a way for people to be funding science projects $100 at a time, that might be a good replacement vehicle. So the problem that you articulate, I think, is a real problem, and I think it's because of the way that capital flows in this country, and it's always chasing the highest return and not necessarily the highest impact.
So one last question right here.
What's your take on valuations right now? Seem to be getting pretty inflated, especially in the Series C, and also with the emergence of the super angel funds coming in and competing more and more with a lot of the VC funds.
Yeah, I mean, valuations are certainly, at the high end of the historical spectrum, and have been for a while. There was a brief period in the financial downturn in 2008 where the market kind of was tough and investors were able to get bargains. But I think that it's hard to find bargains in the venture business right now.
So I'd like to thank Fred again and thank all of you. I want to mention a couple of things in closing. There's a corporate partners brochure out there that describes our program in more detail and who to contact if you're interested. And inside that brochure is a reminder, or there are, I guess, a couple of events I want to mention, but there's a card to have you hold the date, May 7th of 2013. We're having a program joint between engineering and information computer sciences called Ingenuity 2013. The two schools have gone through their kind of student projects from the past year and picked the best projects. And so we'll be showcasing them at Ingenuity 2013, giving out a couple of awards, and there'll be a keynote address by Dave DeWalt, formerly of McAfee. And then in June is the third of our Top Trends in Tech speakers. Thornton May, who's kind of an IT expert, runs an IT academy, will be speaking. Is that June 11? June 11. So very appreciate your coming out to see what's going on at UC Irvine. And thanks again, Fred and Joel, for working with me on this. So.